So we just changed things around a little bit. When you have two amazing women as speakers, they will make amazing things happen. And we just started chatting in the last literally 3-4 minutes. And we said, actually, wouldn't it be terrific if both of them are together? And we have a discussion together. So Adena and Mary both agreed that they're more than delighted to be together and have this discussion. So that's why it's taking just a little bit longer. Nicole from the FT is going to moderate the conversation. And let me start by introducing Mary Erdoes. The most important introduction is she's a Hoya. Okay? You know, that theme keeps coming up again and again. And Mary Erdoes is CEO of JP Morgan's Asset and Wealth Management Division, and they only manage $2.4 trillion in private banking, on the private banking and investment management side. Mary is also a member of the JP Morgan Chase Operating Committee, and she got her undergraduate degree at Georgetown, then she got her MBA at Harvard. And I'm going to let Mary, as they start the conversation, tell us a little bit more about exactly what she does. And then we have, absolutely delighted to have Adena Friedman here. Adena is the president and CEO of Nasdaq. She assumed this role on January 1st, 2017. She's a member of the board. She brings more than 20 years of industry leadership and expertise, and is credited with significant contributions that shaped Nasdaq's strategic transformation to a leading global exchange. And technology obviously plays a big role at the exchange, as we've been hearing all morning. So, ladies and gentlemen, I am delighted to introduce Mary Erdoes and Adena Friedman. Please welcome them.
Why don't we sit here? Sure.
Whatever you want.
Yeah,
We'll make it work.
So slight change of plans. We're teaming up. So thank you both for coming. It's great to have you here. I think, given the venue, technology is a good place to start. It seems to be, what's on everybody's minds, and very much a part of the way that we view the future. So I guess just to start, I'd be interested in hearing, given how technology is advancing both in scope and pace, accelerating, and all the new financial products that have been introduced, are there issues around market stability that you're concerned about?
Do you want to start? You want me to start?
Why don't you go ahead and start looking at it from the point of view of asset management?
So technology is obviously something that is in our everyday life, including 5-year-old children with devices. Like, the whole world is a completely different way of thinking. And so as that applies to money management, it's pervasive in everything that we do. So, of course, we invest very heavily in our portfolio managers, our research analysts, and our traders, but each and every one of them is enabled with technology constantly. And so from the portfolio management and analyst standpoint, that means lots and lots of big data, not to make the decision for them, but to help them to have everything at their fingertips to make it a little bit faster, a little bit sharper than other people, which of course has the unwanted effect of crowding out sort of smaller players who can't afford that, right? So if you imagine JP Morgan Chase, we bank half the households in the United States of America. So when we do that, we have a lot of data on what people do, buy, see, think, spend, save, trending, people starting to be delinquent. We can see that a lot faster than sort of the general data will tell you. So we have big data at our fingertips. You think about the person who's just trying to decide on, stock A and stock B. That's a really hard thing to give them that same sort of access and information. So for us, that's really important for us to have an edge on decision making, and we use that there. But then when you get to the trading is really where our worlds come together, and is very important, which is how do you constantly squeeze out every drop of a place where you don't need to do things with manual intervention, that you can do it faster, you can do it sharper, you can find best execution. And that's where all of the work that Nasdaq is doing to be on the forefront of that. And of course, their major constituents are the tech community first and foremost, and lots of others addition to that. But that really helps them to have the edge, and maybe Adena could, spend a little bit on how that's working and transforming in her 10 months that she's been on the job.
Sure. Well, I would say obviously Nasdaq is a technology company, and we look at serving all of our community with the most advanced technology, including the asset management industry. And I'll talk about that in just a moment. But we have the asset management industry, the broker-dealer community, other exchanges and markets around the world, as well as our corporate clients. And we look at how we use technology to make it so all of them have the most successful interaction with the capital markets that they can have. And they all have different goals, and so this market stability issue is an important one. So if we look at the asset management industry, one of the things we're finding is as asset managers are becoming more sophisticated in how they are using technology to interact with the markets, they also have to become more sophisticated in how they're overseeing the activity and the behaviors of the people in their organizations. Mm-hmm. So we have our smart surveillance technology that serves 140 broker-dealer clients and most of the exchanges around the world and regulators, but we're now creating a new solution that really is geared towards asset management using behavioral analytics plus all the alerting that we have on trading, so that we kind of can customize that so that asset managers, as they're getting more sophisticated, they have ways to make sure that they're checking their people, checking their behaviors, but also that market stability issue and making sure that they're properly interacting with the market. Then there's also, of course, new technologies coming out around trade cost analysis, which I'm sure that a lot more asset managers are looking at to help them understand how that interaction can be more successful. And then more generally, technology is obviously a critical component of what we do so that we can create stable, fair markets around the world, not just our own, but we can use that technology to help other economies grow on the back of great market infrastructure.
So if we take just a step back, what are some of the trends that you've isolated over the next 5 or 10 years that you feel both of your firms really need to be investing in now in order to be on top of that as the world goes more and more in those directions? Because I would imagine there are also trends that pretty much every business inside the financial markets and out is thinking about.
Mm-hmm. Well, I'd say the first trend is a horrible one, which is cyber reaching into each and every one of our daily lives, whether it's just an individual consumer of goods to somebody running a company. And depending on the kind of company that you run, that's the thing that we have to innovate so fast on every day. We spend $800 million a year on defending cyber, and that's not enough. Just imagine putting that to work every day to try and defend the bad stuff from coming in. Why? Because we work at a bank. So the good old-fashioned, like, where do you go if you want to get the money? That would be a good first place to go. And so our defense mechanisms and our perimeter and everything that we do around it is you're constant. I mean, you can't spend enough money to constantly try and stay ahead of the bad guys. And within there, you have to basically do what we call red teaming, but you have to red team yourself. So you have to constantly try and break through. You have to find people who are able to permeate the system, come through, be latent for very long periods of time so you don't know about it, and then find their way to be able to take the money, right? So the biggest fear is the wiring out of money in the bank. It's along the lines of the recent hack that everybody knows about. The real issue is not the company itself that leaked the information or your personal information. It's you. You're at risk, right? Your personal information is out there. So anyone, any day, can go under the radar, start spending little, $19, $20 that won't show up on any of your screens because they have your date of birth, mother's maiden name, everything that you ever needed to know, and they'll be able to find their way through lots of things that you can't even see. And so, as one of the largest credit card companies in the world, like, that's where we have to help. We have to help educate, and then of course we have to defend when we see those bad behaviors. So that's where you get into all of this technology can help you to see patterns of things. So if you don't normally spend $19.99 every Monday at 10 a.m., we can pick that up. But that's not sophisticated enough for tomorrow, right? So you ask 5 or 10 years from now, I have no idea. 5 or 10 years from now is an eternity in technology space. We're just trying to stay, we're generally, 2, 3, 4 years ahead of what the sort of mass population can see, and even that will shorten over time.
So I think that we certainly agree with you in terms of the need to be ever vigilant and invest constantly in cyber. I think that if we look more holistically at the key higher level technology trends, obviously machine intelligence, which will then drive automations, which as well as certainly the movement to the cloud, as well as the potential for things like the blockchain and new technologies to create a lot more efficiencies inside the financial system. And then you kind of layer on top of all of that the concept of quantum and the ability for computers to be ever faster in making very, very complex decisions. And you really have a different game when it comes to the financial services industry. And that, I think, over a span of, is it 5 years or 10 years, really all of those technologies could really become integrated and truly implemented across the system. And what we try to do is say, okay, what does that world look like? How will an asset management firm interact with the markets? How will the broker-dealers manage their trading? What risk can we take out of the system, like post-trade, all of the capital that's trapped inside the banks associated with post-trade? But also, how can you make sure that you're surveilling that activity? All of the, the guys who are trying to break in or basically manipulate the markets are also going to have that technology. So how do we make sure that our surveillance technology and our capabilities stay ahead of the trends that are coming? And so we've been very, very clear with our investors, with our clients, that we're embracing all of those technologies, and we're trying to make sure we're integrating them into what we're creating, which is the Nasdaq Financial Framework, so that we can have markets run in the cloud. We can introduce a lot more machine intelligence into decision making up at the asset management layer. We can introduce faster decision making, and we can take advantage of all the data that's really coming or is here, but also is going to be manipulatable over time.
So that's an acquisition that you've made recently, right? Is something along the lines of tapping more into the demand from asset managers for
information.
Can you talk a little bit about that?
Sure. Well, so those trends are all things that we're doing to invest in organically through the Nasdaq Financial Framework. But certainly, as we look at the sophistication of asset managers, and I'd love to hear your thoughts on how you're developing your asset management strategies, because, as you said, it's an increasingly competitive game for gathering assets. And the resources of the larger firms are going to be unparalleled. But there's also an opportunity for every asset manager to continue to think about how they compete. I do think that, in my opinion, the US markets are the deepest, most liquid,
Absolutely.
most varied. We have a huge opportunity. You probably have the stat, but it's like 77 trillion of investable assets today, growing to like 100 trillion in a very short period of time. So if asset managers have better access to an understanding of how they compete when they're not competitive, why they're not competitive, how do they build a winning strategy? How do they make sure that they're getting seen in front of asset owners, people who have the money? So eVestment is the acquisition we made to make sure, and frankly, to be honest, JP Morgan was our banker on that deal, to make it so that the data analytics are more available to them, so they can compete more effectively in an ever more competitive space. So.
And are those the kinds of tools that you're using more and more?
Absolutely, and just think about how exciting it is to have that technology. Forget about what we can do as asset managers and as capital flow management, right? Somewhere between the two of us and companies like us, everything flows in the world from a capital market standpoint. But what does it mean for the company investing, the pension fund investing, the sovereign wealth fund investing, or the end individual? Just think about all of that data. It's helpful to us. It's much more helpful to you. When I can feed to you your own data in a much more holistic way, if I can tell you that your participants in your plan have been taking out less or have been growing more, or their health and you feed in the health and wellness, and you can be able to tell how they're going to be able to retire and how much more you can leave them in higher risk assets for longer periods of time in order to have them have healthier retirements. When I can show that to you on a daily basis, when I can get that 21-year-old who comes out of Georgetown and all they're thinking about is either paying off their student loans or like just paying for the rent, and train them that each and every dollar you can just put in right there at that first moment, and how that looks and compounds, and get them on that train early, and show them people like you, right? Here's what people and here's the best practitioners in the world, and this is what their portfolio looks like, and this is what their spending habit looks like. This is how much they're paying on rent. This is how much you're going out too much. You're too many Friday nights. Your lunches are too large at the Tombs. You got to cut it down a little bit, because I can see people like you don't spend that much on a Wednesday, whatever. All of that information back to the consumer is so powerful, and it should in the end make for much smarter financial wise decisions on the part of the buyer, which is really our job, is to get the buyer the cheapest, most access to the capital markets, to the greatest companies on the planet, most of them which are based here in the United States of America, so that they can participate in the growth as they go through life, which is our goal.
Another big theme over the past, I would say, couple of years is this shrinking universe of companies that are listed and do want to go public. That the public markets are this idea that the public markets are not as attractive as they used to be, particularly to companies that are on the very cutting edge of innovation that used to be kind of the sizzle in the market. So, what are your thoughts on these trends? I mean, I realize there's no silver bullet here, but what are some of the things that you think could be addressed that would make the markets more appealing? Or is this just a moment in time that will run its course?
Well, I think that we've been pretty vocal in saying that, over the last 10 years or since 2005, so since the last 12 years, there are 1,000 fewer public companies today than there were 12 years ago. So that, to me, is saying that it's not just a blip, it's something that we have to address. And then you say, well, what's the cause? And is that necessarily bad? I mean, maybe these companies are having better access to private capital, and so it's okay. Well, I think that the answer to me is that there's a huge role for private capital, and having worked at a private equity firm, and I know that you provide access to private equity to a lot of investors. There's a huge role of private capital, but at the end of the day, there are two facts that we like to talk about. One is that since the year 2000, if you look at companies before they've gone public and after they've gone public, 86% of the job creation within those companies occurred after they went public. So there is still a really important role of the public markets in driving growth and job creation in this country. And the second thing is the fact that wealth disparity becomes, I would say, more enhanced if you have more and more of these companies staying private longer. So if they can, to be honest, if they can afford to be a JP Morgan Asset Management client and be part of the feeder fund system and get access to private equity or get access to the venture, then they have access to all these amazing growth companies. But if they can't and they're an average saver, then they don't necessarily have as much access. There is some, but they're small slivers of an overall 401k vehicle or of a pension fund. So having them have better access to these companies when they're younger and still in that high growth mode gives them better access to savings, and I would say makes it so that what Mr. and Mrs. 401k have the ability to invest in growth. And
couldn't agree more.
And so, yeah, so I think it's our role in the industry as a bank, as an asset management firm, and as an exchange to find ways to make it so that it's a more inviting environment for companies to go public. And I know Tom Whitman spent time on that this morning, and the Treasury report is kind of reiterating some of our key recommendations around that.
But it's all about regulations. I mean, you can't just have one general counsel when you want to go public. You need 2 or 3. You can't just have one, set of compliance people. Now you need, 3 major ones to check the ones that are doing the first checking in order to check the checker. Like it is madness at some level. And while all regulations, I think, start with the good intention of getting the right thing for the end user, this has stifled it, and now you have 1,000 less companies. 1,000 less companies means exactly what Adena said. You can't, you don't, as a normal human being, you can't get access to participate in the growth of American entrepreneurialism. It's the greatest country in the world to create entrepreneurial companies, and you, general, person on the street, can't get access to it. You need them to be public through the listings of our exchanges here. And we've got to stop the regulations to get them back into the place that they're supposed to be, which is providing transparency and all of the great things, but not so that every filing you have on a monthly basis is like this. And that's what it is. And so it's completely onerous on any company, not to mention, you know, the financial services industry, which is in a whole other stratosphere.
Yeah, and I think that in terms of those disclosure obligations, we like to distinguish between what information is really necessary for an investor to make an informed financial decision, and what is, first of all, some politically motivated disclosures. And I think the Treasury report calls a few out.
Yep.
You know, conflict minerals. I think there's another one, some metals thing. So there's some of that. And then how much disclosure is really necessary on a quarterly basis for an annual basis. Or maybe you bifurcate it and you say, well, look, if you're under $1 billion in market cap, you have certain disclosure obligations. And once you get to a certain size where you can afford to have additional people on your legal staff supplying additional disclosures, then you have, you know, this quarterly 10Q as well as the 10K. Our view is the earnings releases provide the vast majority of the information that investors read on a quarterly basis, but then you still have to file this, you know, in our case is probably a 100-page document every quarter. So, and then you also have the 10K. So maybe you have earnings releases with a 10K, or you do the UK system where you have, you know, semi-annual disclosure obligations with some shorter disclosures on the other quarters. That would be easier. And then on top of that, you've got the biggest issue, I think, that is proxy access and proxy advisory reform. So you've got a $2,000 shareholder who has the ability to put any proxy proposals on your proxy, and then you have to manage that for the next several weeks. Generally, on average, costs between $70,000 and $100,000 for every company to manage every single proxy proposal that's put on. 6 investors submitted 33% of all proxy proposals in 2015. 6 small $2,000 investors. So is that really the best time and money spent by the companies when it's the same ones? And by the way, they just put them back on there every single year.
Absolutely.
So the Treasury report talks about that issue and trying to make it harder to put repeat proposals on, making it higher to have a threshold for investors, things like that. There's a lot we can do to make that are very practical, very tangible, that makes it easier and better to be a public company.
So it seems like, and I know this has been a theme that you've talked about for a while, is this idea that maybe not necessarily a one-size-fits-all approach.
Yes.
That we should be tailoring the obligations to the relative size and importance of the company in the markets. Mm-hmm. Do you also think that there should be some changes on the regulatory side of in terms of investors? Should smaller investors be allowed to participate to a greater degree in these private deals?
Ooh, that's a good question for you.
Well, I mean, yes, and we try to provide that. There are rules of qualified investors, so the amount of money that you have to have, which we continue to try and find ways to give clients access, while remembering that it's an illiquid investment, and you've got to be, you know, obviously aware of that, and whoever's putting your portfolio together has to size it right so that it can never get you in trouble like a lot of people got in 2008. And which, by the way, is still in the memories of most people. So if you wonder why we're sitting in a market that continues to go up every single day, and, you know, some people feel it but not enough, and you still look at the gobs of cash that are just awash in everyone's portfolios, and you ask yourself why, the answer is because every moment of the fall of 2008 and the beginning of 2009 is still on the forefront of a lot of people's minds, and they don't ever want to go through that again. So having that balance of what's liquid and what's illiquid, and then being able to ride through that is really important. But I mean, yes, that's important. It's more important to have companies listed so that everyone can have equal access with a dollar, and that's, I think, that's the absolute goal that our country should continue to strive for. We are the deepest, widest capital markets on the planet, and we need to stay that way.
So another thing that Treasury sounded out in that report was the influence of M&A. So, you know, just to round out the discussion, should we maybe be having some more stricter rules about antitrust, particularly in the tech sector?
I would say I'm not a believer in that. I think that at the end of the day, as long as the consumer wins or the clients win, then M&A can be I think it actually, you know, can be a good thing. And frankly, if you make it harder for companies to come together, that naturally should come together, at the end of the day, the client ultimately is not the winner there. And in some cases, some companies may not be able to survive in a very disruptive and changing environment if they can't consolidate to compete against some of these larger technology companies that really are disrupting certain industries. So I am a huge believer in free market. So I'm not a believer in trying to put further restrictions on M&A just to try to keep companies alive, as opposed to doing what's natural for the ultimate benefit of a customer. Obviously, DOJ will look at it and say, well, if it's not in the benefit of the customer, and it really does create a market power that is ultimately destructive to the client experience and frankly pricing, then that's their job. But other than that, certainly I think these companies should be allowed to innovate, should be allowed to come together, should be allowed to do that to be able to compete with some pretty disruptive forces out there. I don't know if you have anything.
Nope.
I'm wondering if maybe we should pause for some questions. Now, since we changed the schedule, I'm not exactly sure how the timing's going to work, but maybe it's a good idea to see if anybody has any questions at this point.
Hi, my name is Li Yang. Thanks for your presentation. My question is really for our financial situation, whether it is handled by the brokerage in the Nasdaq or NYSE, and also for Morgan Stanley,
Okay.
JP Morgan. I wonder, first is how much lobbyist cost that you have spent, and how much you spend on advertising, or you sponsor, like they say, the study by the think tank, and how do you handle your settlement with the DOJ or other local government for the foreclosures? Why do you only settle for the 2008 rather than the other years? They maybe have a lot of unjust cancellation or credit card, they damage their reputation, and also unjust foreclosure of the homes when there's no default, probably just for other reason. And that is not really clear by the government agency to the consumer. So do you have that kind of consumer information?
Sure. You want to start with the exchange question?
So can you repeat? Sorry, I couldn't quite understand the exchange-related question. I know that there was something related to consumer protection, but.
My question is just how much money you spend for lobby, and for advertisement, or for sponsor or event that you put to any social event, local or think tank or civic organizations.
So from the exchanges specifically? I mean, honestly, we don't publicize that. We're a public company, so we have to, but that's incorporated into our broader, marketing and government relations budgets. I would say that we actually use our own teams and our own people to help us make sure that our, any sort of opinions that we have are heard by government officials, and we do it ourselves essentially. So and we're not really big users of think tanks as a general matter.
Yeah, the questions you're asking on the consumer side are very good and very important ones, and there were a lot of lessons learned as we went through the crisis of 2008 and 2009. There's lots of points of making loans, packaging loans, repackaging them, putting them out, who are the owners, who are the buyers, who are the sellers, and the end person that touches it are the banks. And so no matter how you slice it, the rub is right here between the banks and the consumer. And that's what the CFTC is there to make sure that we protect everything that the consumer does and that the banks do the right thing by the consumer. As JP Morgan Chase is one of the largest financial services firms in the world, worked very hard during 2008 and 2009 to help work through lots of bad things that were happening in the economy. And we think that we did as much as we could to be able to help people, and you can see from the results of the consumer today that we are in a much better situation than we were even as we headed into 2007, which felt like a very good and frothy time in the market. So we have much healthier consumers today. They have much less leverage. They are much more educated There's much less predatory pricing and bad things that it used to exist in the marketplace, and those providers are no longer in existence, and we think that the markets are much better and safer for the consumer as a result.
Hi, Anu Sharma with Morgan Stanley. Quick question for you is, when you look at the technology in terms of the exchanges as well as on the wealth management side, and I happen to come from both sides of your world. Hello, Adena, how are you?
Fine, how are you?
And there was a time where we saw basically two floor-based market exchanges and one electronic stock market. So when you're looking at technology swinging, and I have clients that are 70 years and older, and I'm on the asset management side, they're scared to death of technology, and then you get clients that are 35 years and younger who follow it blindly and just give everything they can to it and don't worry about the protocols. Is there a point where the pendulum goes from one end to the other, where technology will start to come back, where the human element will be somewhat involved? Because we went from a floor-based model, and now we see high-frequency trading, and now we see the advisors, and now they're going to companies like Betterment, who are all robo-advisors. So is there a point where the pendulum swings back?
Sure.
Well, I would start by saying I think that I'm a huge believer in the combination of man and machine. So I think certainly in the asset management space, in my personal opinion, I think that you're going to have some strategies over that are really just index driven, so they're very passive. You're going to have hyperactive, kind of quant driven, and then you're going to have a huge amount of space in the middle for human judgment. And I think that human judgment can come in the form of private equity, can come in the form of public asset management, public company asset management. And I think that it's the combination of those things that make our markets healthy. And so when the market swings too much to one or the other, it probably will correct itself, because of the fact that that balance is very, very important to the long-term health of the capital markets. So that's my personal belief. I also think that the pie is growing very quickly. And so even if there's more assets going into passive today, or more assets going into private equity today, I think that the overall pie continues to grow very quickly, so it will continue to have a huge human element to it. In terms of the markets and just the trading on the markets, I do believe that interaction with the markets will continue to be largely electronically driven, but there are definitely very important moments when humans can certainly interact with the market. I mean, they can interact with the markets all day. They're making human decisions to make investment choices. It's just a matter of the machines executing the trades. But also, certainly on IPOs, we have the underwriters who have total control over the IPO open. And there are a lot of other times during the day where the humans get very involved, certainly in the opening and closing auctions and things like that.
Yeah, and the question as it relates to wealth management is an excellent one. So there are lots of people, as you say, who are afraid of technology, and there are lots of people who are blindly using it. Neither one is a good idea. I think that the ability to have technology help you make smarter, better decisions, sort of show you, visualize outcomes, help you to see things in a more clear way, make sure that you're not getting somebody doing undue trading on your account or other things. There's lots of sort of good ways, again, to the sort of watching for the bad stuff. That can also be very helpful, and that can lead to good answers. Blindly listening to some algorithm tell you to buy or sell something is only going to end in tears at some point in time. It's for sure going to happen. And blindly having a robot manage your money is also going to end in tears at some point. And so you can't have that. Siri is not going to hold your hand through 2008, 2009 and walk you through what's happening and why it's happening. It's either going to keep buying as the thing goes down, which you don't want, or it's going to sell because it has some algorithm that says sell, which you don't want. It's going to have to figure that out. You need human interaction. It's absolutely no different than the hospitals of the world. You wouldn't go to a hospital today that didn't employ super modern technology to be able to see a particular disease and how it was treated in lots of hospitals around the world and all that big data that they use, but you wouldn't let the robot work on your body. You need a human being that takes all that information, that synthesizes it, that looks at you in the whites of your eyes and takes the whole picture and says, I think we will apply these portions, and this is what we're going to do for you. And I think that's exactly what the wealth management industry will be for as far as I can see.
Thank you.
You've both spoken about how important it is to have public companies, listed companies, and we want to do more. So index providers, Standard & Poor's and FTSE Russell have started addressing the issue of shareholder voting rights. I want to just hear your comments on
Sure,
it.
sure. Yeah, we definitely have a difference of opinion. I would say, and we've been pretty vocal about that too. So in our blueprint for revitalizing the U.S. capital markets, we do specifically state that we support dual class structures for companies that are looking to go public. I think that, and there's a specific reason for that. So if we think about companies that are founder-led and are looking therefore to go into the public markets, there's one big gating issue, which is being able to feel like they continue to have control over their company as a public company. So there are choices that we can make. Number one, in the current structure where we do allow for multiple class structures, the investor gets to make a choice. It's fully disclosed to them as to whether or not this company has one or two classes or multiple classes. It's fully disclosed to them that the public shares may or may not have certain voting rights. And the investor can make a choice. Do I want to be a financial investor in this company or don't I? And they are just making a decision to be a financial investor instead of a governance investor. And I believe that they are given that choice and it's fully disclosed, and therefore that should continue to be available to them. Because the alternative is that that founder doesn't go public. That company stays in the private hands. They continue to find ways to capitalize their business in the private space, and therefore that investor gets no ability to invest in that company at all. And I don't think that's the right choice. So I'd rather we're a full what we call a disclosure economy. Disclose the information, allow an investor to make an informed decision, and then allow them to become a financial owner of that company, but even if they don't have full governance rights. And that's our position, and we will continue to run our index business along those lines. So the Nasdaq 100, the biotech, and all of our indices will continue to allow multiple class structures.
Ladies, good afternoon. Steve Cohen, Solex Technologies. Adena, you and I had met in New York, and I appreciate the introduction to Terry. I guess this is more for Mary. Same question, which I had asked Adena in New York. How is JP Asset leveraging big data technology to sort of generate a different approach or get different customers than your competition? What are you guys doing for that?
So we think that it will be basically table stakes to have very sophisticated data, technology, everything to help make better decisions, to have a portfolio that's more proper for you than it is for your neighbor. And then that will constantly be augmented and refined so that that will continue to get better and better over time. But where you can take it to a whole other level is to actually feed back your own big data to you in a way that can be helpful to you in other ways, okay? So let me give you a for instance, and this relates to the private markets. So we happen to run the largest core real estate fund in the United States of America, and so we happen to own a whole lot of malls. And there's lots of good stuff happening in malls, and there's lots of bad stuff happening in malls. And they're going through a complete transformation of sort of who's going to make it, who's going to not, what's going to take up that space. Is it more of an experience than it is, and then you go home and you shop online and all that all the moving pieces that we have in that. If you happen to own a share of our core private equity fund, you should have all that data at your fingertips. I should, because you're an owner of it. I should let you know price per square foot of the malls in Southern California versus the malls in Minnesota. Which malls have, sort of default or decreasing rates? What kind of retail companies are coming in for new leases versus not? It should just make you smarter. You can do whatever you want with it, right? But to be able to give you, the buyer, even more information to do whatever you want with, because you own it, is really important. So you can imagine how that also applies to public companies. And being able to package that and give it back to you in however ways you want to know. So if you happen to run some kind of a company yourself in a particular industry, you can ask for all the information that relates to that industry, and you should get that served to you by your asset manager in a way that isn't even thought of today. And I think that's the super exciting part of what all this big data can do. Because big data for the sake of big data is just a lot of data.
Thank you. Appreciate it.
Hi, my name is Akash. I'm a freshman at Georgetown, and I have two questions, one for Adena and one for Mary. My question for Adena is there's been prevalence of ICOs using Ethereum, and what are your thoughts of that? How is Nasdaq going to take advantage of that? And my question for Mary is, where do you think the future of asset management is? I've heard a lot about it moving towards passive index funds and PE, but I'd love to get your thoughts on that.
Sure. So ICOs are a really interesting construct that have come into the market very, very quickly.
Can you explain what ICOs are?
Sure. So, well, I don't know if I can actually. So initial coin offering basically is, it's a way to raise money in, I would say, kind of a crowdfunded type of manner, where you basically put up your business plan or you put up your concept, or maybe you're putting up a real business that's already operating into a portal that allows people to make a decision as to whether or not they want to, quote unquote, invest in that business, but in the construct of them getting the potential to join in future profits. And basically they get a Bitcoin or an Ethereum certificate that establishes the fact that they have some sort of investment inside that company. So people are saying this is an alternative to an IPO. I think that the SEC has come down and said, well, then if it sounds like and smells like a security, it should be a security and should be regulated as such. So the question is, are they going to be regulated as an IPO would be regulated? There are reasons why IPOs are highly regulated. You want to make sure that everyone has equal access to information, that they understand that there are certain disclosure obligations that a company has to make so you can make an informed investment decision, that an equity is a piece of ownership. It's a concept of ownership of that company. You're essentially in the cap table for a reason, and you're sitting in the stack for a specific reason in terms of your rights to liquidation rights, essentially. But ICOs are none of those. So there is no standard for disclosure. There's no protections for the investors. And they're not gaining any sort of ownership rights. They're gaining the potential right to a future profit, potentially. And there's no government, any sort of oversight of that activity by any government official. So I would call that a bleeding edge type of construct, just like crowdfunding has been a pretty bleeding edge type of construct. Nasdaq doesn't tend to get engaged in the bleeding edge. We get engaged in the leading edge. So as we look at whether or not that construct becomes standardized, whether it does become a security, whether it can be regulated as such, we have something called the Nasdaq private market where we could accommodate those types of capital raising activities, but we're not ready to establish it as an established practice. So we are certainly looking at it and understanding it, but we're not currently investing in it.
Could you see Nasdaq getting into cryptocurrencies at any point? Or?
So we are very engaged in the blockchain and the underlying technology behind Bitcoin, and we are actually integrating the blockchain across our entire market infrastructure stack, and we've deployed it inside the Nasdaq private market, and we've partnered with Citibank on that. So we have a very good understanding of it, but in terms of the actual application of the blockchain towards cryptocurrencies at this point, in the Nordics, we actually do some work with essentially a cryptocurrency index. So in the Nordics, that the government there has kind of taken a different tack, but in the United States, they have not, and they're not currently ready to embrace it in the same way that other governments have. So at this point, we continue to evaluate it. We may or may not get involved. Our technology is used, however, in the Bitcoin space, but we're as a market ourselves, a market operator, we have not yet made that decision.
And then you asked a great question about active versus passive management, which seems to be the question of the last sort of 5-6 years. And it's a funny one for me because I think that there's lots of room for passive management in people's portfolios where you just want to set it, forget it, and you're not going to look at it for another 50 years and it's there. It's inconceivable to me that you wouldn't also think of actively managed parts of your portfolio. First of all, at the portfolio level, you need to be active because you don't stay the same. You don't stay a freshman in college for the rest of your life. Your age changes, your needs change, your risk profile changes, your life changes, your obligations change, and so with that, your portfolio has to change. You have to be very active about that. And then when you actually graduate from college and you come work at JP Chase, we'll show you how when you sit in front of one CEO and another CEO, there are very stark differences. And so only the human brain can say, which one of those two people do I think has got a better strategy for 5 years from now? There is no technology in the world that's going to tell you that. That's a human judgment. And that human judgment is a critically important one for the capital markets, and that's what makes the capital markets, and that will never go away. It will just have, you'll just have other means of being able to invest. And so it's very difficult to say for an entire portfolio, you should own the 500 largest companies today, period, end of sentence. Because those are not necessarily, and probably not at all, going to be the 500 largest companies of tomorrow, and it's someone's job to figure out which ones those are. And it's probably worth noting that over 40% of those companies have had no revenue growth.
Thank you.
Just think about owning 40%, over 40% of a portfolio that has no revenue growth. That's not a good investment for the future. You have to figure out how you're thinking about what's the right investment for the future. And that's why you should study really hard in school on your math, science, econ, and business school courses, and then come and work for us, and we'll use that brain of yours. We'd be very excited. We're one of the heaviest recruiters from Georgetown, so we're really super proud of all of the people that we get from here.
Looking
I
forward to it.
know
Thank you.
we can go on and on with questions here, but I did promise that we'll end on time because I know you have other commitments that you need to get to. Please join me in thanking Adena, Mary, and Nicole.